Hello, everyone. I just bring everyone in. All right. All right, people are starting to join. Hello, everyone. If you're joining us right now, let me know in the chat where you're joining us from. That'll be great to know. Just want to make sure we're live on everywhere. Yeah, just use the chat, guys. I'm just going to open the Facebook group as well, just to make sure that I'm going to see the messages in there as well. All right. Yeah, guys. So yeah, let me know, guys. I want to make it an interactive thing. So let me know in the chat where you're from. Let's turn on cameras. Let me know. I'm curious what got you here, guys. Like, what specifically got you to this call? I'm curious what specifically got you curious about this specific one. Is there anything specific you saw in an ad, an email that got you to this call specifically? So now I know I'm talking to the right crowd here. All right. Informal discussion about deal in North Carolina. Hi there. Cool. Good stuff. All right, guys. I just want to give it another minute or two to see that everyone's joining us, see where you're from. Thank you for those who are turning on cameras. Let's turn on cameras. If you want me to answer your questions eventually, I'd love to see you turning on your camera. I think we are live also. We're supposed to be live in our Facebook group. Just double check that. All right. Cool. I'm just going to share quickly, guys. Give me a second. I just want to make sure I want to share this call in the right group. Let me know in the meantime what kind of questions you have for me for today. I have a presentation I want to go through on a roll-up and what that looks like and the roll-ups that we're working on. Yeah, let me know if you have specifically things you'd like to learn or understand. Also, let me know if it's the first time you're here or you're already part of my other webinars or watch other videos of mine. All right, continuing education. Cool. All right, guys. So first time here. Cool, guys. Fair enough. So I'll get right to it. In a nutshell, guys, if you don't know me, my name is Mohan Pover, founder and CEO of Acquisitions.com. At this point, we're the largest community of M&A investors, entrepreneurs, and roll-up investors and entrepreneurs. We're involved in 100+ transactions in the last 3 years. Now we're also looking to invest and partner with our clients. Today, I'm going to share with you a presentation that I created when it comes to doing a roll-up. It's a presentation that I shared with potential partners of ours. Basically, they came to us from one of our programs. They introduced us to dozens of potential deals that want to join on a roll-up, and we are basically taking a lead on that. And they are joining as a scout. So there's basically, for those of you who don't know about what we're doing, we have basically, call it 3 gears of being in our community. So the first gear is for people who just want to passively invest in deals. Those are usually accredited investors. They don't want to do work. They just want to go out there and pretty much just invest in deals. The other vehicle is for people who just want to be scouts, people who want to find deals, and then we pay them a commission for finding and bringing deals. So we have investors, we have scouts, and then we have CEOs, people who want to take an active role on doing deals on their own and basically be the major owner of the acquisition or a roll-up. Anyway, let me share with you my screen, guys, real quick. I think that'll be really, really helpful for you to just see what I'm thinking about lately, what is in my mind, and how it can potentially help each and every one of you to buy your first business or do your own roll-up. Let me show you what that looks like. Let me share my presentation. And just give me, please let me know, give me a thumbs up or a message in the chat if you can see. And let me know what you can see, because hopefully I shared the right screen. So let me know, please, if you can see my screen, and if so, what can you see? The presentation, cool. Appreciate it, William. And I see Tony is saying, I have a specific question around getting the policies and SOPs fully documented. The risk is if all key employees quit, then you end up with nothing if not documented. Yes, 100%, Tony. That's part of your due diligence, or if you understand how to run a business in the first place or buy a business in the first place that have good processes, that have good systems, that you understand what the org chart looks like when it comes to understanding their sales, marketing, operations, finance, legal, HR compliance, all those things in a business. You definitely want to have an understanding and a deep dive walkthrough and due diligence when you're doing a deal to see, okay, here's what's up in the business, here's the opportunity, here's the gap, here's what I can bring, or here's my potential downside, and how obviously it's your responsibility to make sure that you're protecting your downside as much as possible. And in the end of the day, understanding that business in general is risky, right? So also keeping that in mind as well, knowing that every business is risky. So at some point, and I'm sharing with you kind of like different perspectives, because I see different challenges with people. Some people are just not doing any due diligence at all. That's bad. They don't know what kind of due diligence they need to do. They don't know what details they need to check when they do a deal. The other side of people is people who are just afraid to do anything. They just rather learn forever or stay in their comfort zone forever instead of having courage and jump into the water. And sometimes, just doing something and doing a deal. And sometimes doing a deal and losing money is better than doing nothing. I have people who came to me after doing very bad deals. I'm talking to people who spend their life savings and family life savings on businesses that are distressed, that they had to redeploy and deploy more of their own capital just to keep the business alive, business that is losing money. I think it's really bad. And that's why they came to me after doing those bad deals. At the same time, that deal is what brought them to me. And I'm not saying that I'm anything special. I'm just saying that the fact that they beat that deal was almost like the point of no return. It's like, okay, I failed, but there's no way I'm giving up, because the pain is it's almost like, as weird as it sounds, I feel like sometimes we need to run away from pain to really be successful. You'll never see someone who's like a kid. Let me give you a weird example, right? But if you see an ice cream truck, you'll see kids running to the ice cream truck, right? They'll be excited, they'll be happy, they'll run to the ice cream truck. At the same time, who's going to be more motivated? Someone who's running towards an ice cream truck, or someone who's running away from a burning building? So the person who came to me after doing a bad deal, he was running away from a burning building. And I'll work with those people every day, because I know they have fire in their guts. They're willing to do whatever it takes. So sometimes, I don't know how we got to this, but I think it's very important to understand that there's two sides for motivations in life in general. And sometimes having something to run away from is as powerful as running towards something. Anyway, guys, with that being said, let's talk about roll-ups. So let me just make that a bit here. So anyone here know what is a roll-up? So if you didn't know, now you know. Simply put, roll-up is a strategy where you seek to identify a single company or set of companies within an industry, and you leverage the use of both debt and cash flow to acquire additional firms in an industry. So basically, a roll-up is the opportunity or the idea of going out there and trying to buy as many companies as possible in a sector, merge them together, and build the biggest company that you can. Why would we pursue a roll-up strategy? Well, larger companies have access to increased efficiencies and economies of scale. In addition, larger companies are much more attractive to potential acquirers during exit scenarios, and it's not uncommon to see multiple expansion of what a business could be worth as they continue to acquire smaller bolt-on acquisitions. So what advantages are there to rolling companies up? Well, by acquiring multiple companies in a particular industry, we may be able to take advantage of some of the following key profitability drivers. Things like increased purchasing power, right? So larger order size could mean increased negotiating power with suppliers if you're a bigger business. It means shared overhead costs. So things like rent, utilities, office, supplies can be eliminated by consolidating locations. Reduced back office needs, right? Larger companies could expect to save on accounting, legal, and other back office costs. Streamline processes to drive efficiencies. Streamline processes like sales, AP, AR, onboarding, payroll, by utilizing software that may be too expensive for smaller companies. Larger geographic footprint. Larger companies may be able to cover more ground and take advantage of localized market dynamics. Does it make sense, guys? I just want to quickly go through the chat. Enforce the process during due diligence. Not sure which process you're referring to, Tony, but yeah, in due diligence, you can pretty much make your own rules. Can you send me the replay, Moran? I have to jump off here a few minutes to get kids off school. Yeah, Jeff, no worries. As soon as the recording is ready, I'll just tell my video editor to upload it to my YouTube channel. So it might take a few days, but yeah, I'm happy to just make sure that we're recording actually. Yes, we do. And I think we're actually live streaming it in one of our Facebook groups. So if we do, and it's hopefully working, then the recording should be there automatically after the call. All right, guys. So what ingredients make for a good roll-up? So some key factors to consider. Fragmented industry, right? The best roll-ups are in fragmented industries where there are few to no key competitors with scale, or where most participants are small to medium-sized mom and pop businesses. And that's kind of like what is getting us excited the most right now in acquisitions.com, is the idea that there's so many businesses out there right now with business owners who are motivated to sell, business owners who are looking to sell. The next generation is going to be insane. Like the amount of capital that's going to change hands with all the baby boomers looking to retire is unlike anything I think the world has ever seen. And that opportunity allows us to focus on different sectors. And that's why we're doing what we're doing with acquisitions.com. I know I can help any entrepreneur who want to buy his first business, buy a great first business, and we can help existing business owners to grow their business by acquisitions. And we can be the full, call it the operations, almost like the operation system for them to create that roll-up, to grow, to help them with everything when it comes to finding deals, analyzing deals, raising capital, closing deals, operating the business, because nuances matters. Otherwise, I don't know if some of you here are business owners, but if you are a business owner, you know how difficult it is to start a business, to grow a business. If you tried to scale the business in the past, all of you probably at some point hit some kind of a break point where you didn't know how to scale things further. And usually it's a combination of just not having enough efficiencies with what you do, with who you do it with, and with how you do things, with your processes, your systems. And that's what we really try to create here, to have like a full ecosystem for people who want to grow by acquisitions, because the last thing you want is to buy 10 messy businesses. You got to have good fundamentals in place so you could scale things. Let me know if it makes sense, guys. Hopefully that those things create curiosity in you guys as well, because it's definitely for me. I know that in the past, I had dozens of businesses that were in a mess. And if you think running one business is a challenge, running 10 or 12 or 15 can be very challenging if you don't have those good processes in place and good systems to keep everyone aligned and accountable and incentivized to grow towards a larger vision that you have. Anyway, back to ingredients for a good roll-up. So motivated or aging seller population, like I said, sellers in industries that aren't sexy, they have less of a chance of passing the business on to their children or other heirs, representing an opportunity for motivated acquirers, right? No one wants, like, there's so many, we're looking at like plumbing companies, so many good companies that are super profitable, but in the end of the day, their kids don't really want to be involved in those businesses, right? Every young entrepreneur, what they want to do, they want to be the next Uber, the next Airbnb. Next one, recurring contractual revenues. So generally revenue that contractually guaranteed and recurring ideally. For example, software, a lot of SaaS companies out there are like that, would be seen as more valuable when compared with revenues that chunkier and not necessarily recurring. For example, some large contract manufacturers, construction, etc. So ideally, we want to find businesses that have that recurring revenue, that have clients that over time pay more and not less, that we have clients that are staying with us long term. Those are the best businesses. Obviously, it means that we'll potentially need to pay them more, but sometimes it's worth it if the business is, just more robust. History of profits and growth, all else equal, it's much easier to get excited about companies that have quantifiable history of profits and growth with the ability to reinvest profits into growing the business. These types of businesses are also able to more easily be leveraged if a friendly banker can have more certainty about the cash generating ability of the companies, right? When you want to buy a business, the best thing for you is to have a business that have such great history of profits and growth and revenues and recurring revenue that it will allow you to access more of other people's money, to allow you to do bigger and better deals. Low capital expenditures means asset-light businesses like software are generally viewed as more valuable when compared to businesses where constant maintenance capital expenditures must be spent in order to maintain the economic viability of the business. For example, oil and gas exploration and production, right? Very important as well. High defensible margins, or what Warren Buffett call moats. A company's ability to maintain higher margins can signal clear pricing power as well as significant value in the eyes of customers. This could come in the form of mission critical parts, price insensitivity for the customer, lack of sophisticated competitors, or brand value. For example, who here likes Apple products? Like, would you be willing to pay more for Apple product if they raise their prices? I know that I would. It's like I'm so sold on the brand that I don't care how much they'll charge me, I'll continue to buy their stuff. And that's a huge moat for a business. They just created such a, man, it's like, I at this point, it's so weird, but I don't see myself owning anything but Apple when it comes to computers and phones and headphones, and it's like everything. So that kind of company can charge more, can have better margins, more profits. That's why it's such a great company. And at any point, because their customers are so loyal, how easy would that be to add like an additional service for Apple for like $10 a year or $100 a year? And adding something like that could easily create so much more, increase in profits for a company like that. So ideally, we want to find businesses with great moats. I'm not saying that we can find Apple, right? Especially when we're looking for small businesses and old school and boring in quotes businesses, but we want to find, businesses with some secret sauce, something that potentially can be unique. And that uniqueness can be even systems, processes, ways to keep everyone accountable that is better than their competitors. That in itself can be super valuable to the market. So how can deals be sourced? So sourcing and process. Once we determine an industry where we believe an opportunity exists, it's time to start finding an initial candidate or candidates for acquisition. At this point, we build our outreach funnel in order to optimize the number of qualified or quality leads that we can get. Deals can be sourced a variety of ways. Some examples are outreach to business brokers, working personal network, cold outreach to current business owners, landing page and CEOs, ads. There's a lot of those strategies that we have. Different strategies like social media, letters, cold calling, going to events and whatnot. After a potential target seller is identified and has expressed an interest in selling, the acquisitions.com team can evaluate the opportunity in order to move to the next stage. Assuming we get all the way to a signed LOI, we will begin due diligence. Assuming everything in diligence checks out, we will close on the deal and begin to streamline operations as well as begin looking for the next deal. So that's kind of like what the funnel looks like, right? Pretty straightforward. There's an initial reach out. Usually there's going to be some kind of follow-up with the business owner. And then continuing of screening and introduction, in-person meeting. Nowadays can be a Zoom. But then LOIs, signing LOI and closing the deal and doing the transition with the business. The most time-intensive part is definitely the outreach, to identify targets, to make lists, to contact potential sellers. We have in our network, like I said, scouts that are very valuable during outreach. There are, just great opportunity for us to scale this opportunity of doing those different roll-ups. a small investment in data providers is very common, or different subscriptions to trade shows, industry publications can also yield dividends through a pre-populated contact list. So that's kind of like sourcing. This is kind of like what a sample roll-up model actually looks like. This model shows a potential deal that the Acquisitions.com recently screened and still working on. The analysis assumed we acquired 7 companies within a certain industry simultaneously. This deal had all of the hallmarks of a good roll-up. The industry is operated in a highly fragmented industry. There were significant efficiencies we could implement from day one, including cost-saving initiatives and outsourcing repeatable tasks. We benefited from economies of scale post-close due to the greater size and scale of pro forma entity. We believed we would be more competitive in the bidding process for new work. That's kind of like what it looks like, just to give you an idea of a model if you'd like to see. For some of you, it might be too overwhelming. For some of you, it's not, but I thought it will be cool to have it here as well. And those are, that's kind of like sample return analysis of what it looks like, assuming that we could enter at 5x and acquire, let's say, 20% of our EBITDA per year at 4 or 5x. We assumed some base margin improvement due to efficiencies we could implement from day one. Finally, we assumed a modest leverage profile, so 3x gross debt on EBITDA at close. And based on the scalability of the acquisition in question, this is a deal we would find very interesting. And as you can see, the returns here could be really, really good for anyone that might want to be involved in a thing like that. So we are currently in the market for new potential platform deals and are willing to look at a variety of industries provided it meets our criteria. We're willing to pay finder's fee if we are brought a transaction that we ultimately close. Example, finder's fee structure includes basically up to 3% of net revenue or up to 100,000 for every 1 million EBITDA at closing, and potential equity in deals that close. The criteria for those roll-ups are ideally higher recurring revenue, loyal and diversified customer base, fragmented market, non-cyclical, recession-resistant revenue, 3 to 20 million. It's kind of like the sweet spot. EBITDA and or annual cash flow, 500,000 to 3.5 million. Flexible here as well. And we want to see at least 3 years history of profitability. So that's what it looks like, guys. I thought it will be cool to share it with you. Hopefully it opened your eyes to what's possible and what that looks like, what a roll-up like this could look like. You can do 1 deal at a time, you can do 5 or 7 at a time. It all comes down to your resourcefulness, how hard you're willing to work, how many deals you have in your pipeline, and your skills of going through negotiations on those deals, and of course closing them with capital and knowing how to operate them. And that's why right when we started, I wanted to introduce you the fact that if you're part of our Acquisitions.com, call it community, you can join us as a scout and just find deals for fees. You can be eventually an investor if you're an accredited investor and invest in deals passively, or you can become a leading CEO or someone who's leading your own acquisition or roll-ups. And to do that, you can join our Acquisitions Accelerator, where we will even refund our service fee, if and when you allow us to invest and partner with you on deals. So that's hopefully summarizing kind of like what we're up to, guys. So with that being said, I'm happy to answer questions in the next minutes, and then we'll end the call. And yeah, I see a message. For those of you who are looking to chat with us, you can go to acquisitions.com/apply. I'll put the link in the chat. And if you didn't talk to us yet, guys, I suggest you have a chat with me or my team. Let's see where you're at, where you want to be, what are your goals, and see if we can help you or not. Yeah, so that's my short presentation. I'll just see if you guys have any questions today. I'll wait for a few more minutes. Otherwise, I wish you all a great week. So I'll wait a few more minutes, guys. If you have any questions, just put them in the chat and I'll try to help as soon as I can. How much is it to join? G Clay, I suggest you book a call because we have services anywhere from like literally $1,000 up to like being a partner and taking equity in your deals. I'm talking about for existing business owners, right? So we're not doing success fees, guys, just to make sure we're clear on that. We're not going to work for free for you and get you and get paid only at closing, because we have too many opportunities like that, unfortunately. So the goal is to basically bring you onto our accelerator, get you to a point where you know as much as me and everyone on our team when it comes to acquisitions, so we could do deals together. That's the reason I created it in the first place. And that's why the incentive is basically, hey, if you join us and you allow us to invest in your deals, then eventually we'll even refund our service fee. So there's an incentive to get results. And basically the only fee here is basically your deposit as a skin in the game deposit to make sure you're actually out there doing the work and you're not wasting our time. And we are making sure that we are not working for free with someone who's not taking this seriously. Around how many businesses can we purchase and close in a year, and how long does it take to join? How long does it take to join? I suggest you book a call with us and let's see, like I said, see if we can help you in the first place. In terms of how many businesses you can acquire in a year, so I'll split it into two stories. One of them is a guy by the name of Dan Genzel. He bought 24 businesses in a year. That was his best year. But our largest roll-up was a $200 million roll-up that built in less than a year, buying 16 companies, doing about 52 million in EBITDA. So that was the largest size roll-up that I was involved in. At the same time, I think that it really depends on what's your background, what's your experience, because everyone here is going to have a different learning curve, right? If you never had a business before and you don't know what a P&L is and what a balance sheet is, then it's going to be more challenging for you. So even if you're going to do one deal in the next year, so what? I mean, don't think it's going to be worth it. So that's kind of like what I would tell you that I would probably want everyone here to target to close at least one business doing at least 7-figure in revenues in the next year. That would be my goal for you. But the sky's the limit when it comes to those things. Guys, the biggest companies in the world, that's what they're doing. They're doing acquisitions. So really, really, the sky's the limit when it comes to doing acquisitions. And that's our goal with acquisitions.com over the next year, is to really support those people who don't just want to do one deal, but those who want to do more and more and more deals and just build large companies. That's where my excitement is, and that's the ecosystem I want to build for people who are excited on doing those things. Like, I just had a call with a colleague who just sold one of his companies, basically a roll-up to a public company for 150 million also, right? In a very short period, like in less than 3 years, from zero to an exit of 100+ million, very, very fast by acquisitions. Those are the results that are possible. That's what excites me to work on. And moving forward, I'd love to see if we can even take some of you guys public with different roll-ups or companies that you work with, and be involved in that as well. That's definitely what's next for us. Call, book, talk tomorrow. Nice, good stuff. How long does it take to close a business after brought to the table? I have no experience, but I'm highly interested. So when it comes to how fast it takes to close a deal, it depends, right? So assuming that someone accepted your offer and is willing to sell your business, I'll split it into two. So let's say that the business is profitable and you want to do your due diligence. I would give it at least 60 to 90 days of proper due diligence. That's good enough time for you to dive into all the details if you actually want to close on the deal and raise the capital for the transaction. At the same time, if you're doing distressed deals, which I don't necessarily suggest as the first deal, you can literally close those within a few days because it's just a simple agreement and there's no even any money involved in the transaction. Same with with other type transactions, like if you're taking equity for your value and whatnot, those are deals you can do very fast without even due diligence, because you're doing due diligence basically after you close on the deal. But I would say give yourself at least 3 months. I see a question in private. There are thousands of niches, but after applying the filters, there are fairly few, especially if you need to emote and growth. Aside from tradesmen businesses, can you discuss the other sorts of business niches you like. Yeah, so when you will work with us, I can give you niches that we are part of. I can tell you that we were involved at this point in so many sectors. We're involved in insurance, e-commerce, marketing, trucking, financial services, insurance, dental, IT, HVAC, plumbing, roofing, staffing, pest control, personal trainers, electricians, construction, IT, I said, security, construction, mobile home parks, hotels, landscaping, CBD, and even funeral homes. So it's kind of like we've seen a lot of those businesses out there, and I can tell you this: you can make money in all of those and more. Right? That would be my answer to you. So I think what's most important, that's part of the work that we do with our clients, is diving in to understand what is the best sector for you, right? What is the best sector for you based on a few criteria that we can walk you through to make sure that that's a sector that's worth focus in for you based on your background, your experience, and your passion. Yes, that's me. Where do we find the deal? I'm booking a call. Do you charge to book a call? No, so the call is free. To talk to us, you just need to go, I'll put the link again in the chat, but you basically just need to go to acquisitions.com/apply. Let me put the link again. So just added it to the chat again. Yep, so that's that. Cool, that's it, guys. I don't see any other questions. So if you don't, I suggest you book a call with us, guys. If you never talked to us yet, book a call. Let's see if we can help. We might be able to help you. We might not. You don't have anything to lose. Okay, I see another question. Guys, you don't need to send questions in private. You can send it in public so everyone will see, but I'll just read through that anyway. So the question is, platform companies with a management team could sell to management or could sell to an angel. Can you discuss what you see about why platform companies might sell to a no money down acquirer? So platform companies, RB, the way that I see that, I won't even consider a platform company unless it's doing 100 million in revenues, just to give you an idea. When you look at the private equity firms, they won't even consider a platform company unless it's doing at least 100 million. So that's first. Right? Then you're saying platform company could sell to a management or could sell to an angel. Why would they sell to a no money down acquirer? First of all, I don't like to say no money down. I'm trying to get rid of that phrase, to be honest, because I don't think it's fair. Because when you buy good businesses, you do pay money. And if you don't pay money for a business, guess what? It's probably not a good business. So we definitely do pay money for good businesses, but the money doesn't necessarily to come from your own pocket. So the seller, when you're buying a business from a seller, the seller don't care if the money is coming out of you or it's coming out of someone else. If it's an investor, if it's a bank, if it's an institution. So that's what I'm saying. I don't like the no money down promise. I like to use the other people's money term better, which means you basically go out there, you bring in investors, you bring in institutions, you bring in different deal structures to access the capital so you could buy good businesses that are profitable, that are bringing good cash flow, so you could make money from those businesses. At the end of the day, especially if you guys don't have experience in business, to buy distressed business is it's going to be challenging. If you never had a business before, the first deal is going to be distressed, it's going to be challenging. Trust me. So I don't recommend to do your first deal as a distressed one. I recommend to do the first one, a profitable one that can bring you cash flow, that can help you build systems and processes. So even when you buy a distressed business, then you at least have an existing one with good processes and systems that can bring in those distressed assets into the existing one, and then it can work much better. But otherwise, if you just go directly to a distressed business and you never had a business before, it's just going to be a nightmare. And I'm telling you, I've seen horror stories. I get emails all the time with horror stories from people who bought distressed businesses because they thought it's cool, I'll just do a deal faster. But they end up with a business that's losing them money every month. And like I said, I've even seen people that, have to use their savings, their family savings, to just keep that business afloat. And it's why you're doing that. I mean, the goal in the business is to bring you money, right? To bring you money, to create jobs. So yeah, I don't recommend it to start with. And why would someone sell it to you? If you're buying a good profitable business and you can make a good offer and the seller likes you more than he likes the other buyer, then he will sell it to you, right? So it's about knowing how to build a rapport with them, how to create a connection, and how to negotiate in a way that they prefer to work with you versus someone else. William saying, I realize the business can be bought for $0 down, but there are still other costs. Roughly how much are they? Yeah, so again, you would definitely have costs. So it depends on the size of the deal, but let's say you're going to have accountants and lawyers and legal costs to close on a deal, right? So, I mean, I don't want to lower your expectations, but I mean, you can close deals right now with, like, you can pay a lawyer like $5,000, $10,000 to do simple agreements, right? You can pay an accountant to go through a lot of the finance due diligence. You can do a lot of the business due diligence on your own if you understand what you need to check, right? So people think that it costs a lot of money, and a lot of it comes down to the fact that a lot of entrepreneurs go to big four firms for their first deals. A big four firm for due diligence will cost you a small fortune. Like it will cost you sometimes more to pay them for due diligence than you'll make from owning the business. So for your first deal, especially if they're small ones, you can use, I suggest, a smaller firm or smaller firms to help you with due diligence. And then when you work with us, if you work with us, we'll show you also how to get success fees. So you'll only pay them even when the deal is done. And that comes down to you knowing how to position yourself as a credible buyer, knowing how to tell them, what to tell them, how to tell them, and how to make sure that they're taking you seriously, even if you never bought a business before. Because if you know how to do that, then a lot of them will work with you on success fee, which means that you don't even need to pay them up front. You can pay them only if and when a deal is done, and you pay them using the business cash to do that, right? So it's not necessarily from your money either. But it comes down to, again, you knowing how to position yourself as a credible buyer. And that's one of the challenges that I'm seeing a lot of people are going through. They're just out there randomly approaching business owners saying, hey, I'd like to buy your business. And they're creating themselves a bad name. They're spamming LinkedIn and whatnot. And they're creating a bad name for everyone who's trying to do deals. So I think before you have good fundamentals and confidence on what to do, how to do, what to say, how to even understand if a deal is a good deal or not, how to access capital to close those deals, then, like, make sure you understand the full process before you go out there and just try too much. That's what I would suggest. How much capital will I really need to do my first deal? So yeah, that's like, to give you an example. Like in reality, you don't really need to use your own capital if you don't want. Like, you might have ongoing expenses. Like, for example, if you're going to use LinkedIn premium services, right? That will cost you what they're charging now, like, I don't know, $100, $200 a month now. If you're going to use letters, if you're going to go to events, like, most of the expenses you're going to have is going to be throughout the deal flow work, right? You're going to drive to meet a seller. If you're going to use Zoom accounts, right, up to 45 minutes, that's free. But after that, you need to pay. So you have different ongoing business expenses that you can write off anyway. And then after that, it's all up to you if you want to spend more money or not, right? So obviously, you can put your own money. Like, I have a lot of people in my network that just want to put their own money into deals. Because I think investing in small business can get you great returns, right? So if you want to put your own money, you can do that as well. But it's not a must. You can go out there to an investor that he will put the money, or go to banks, they'll put some of the money. Other deal structure you can use, right? Like, you can raise capital from a competitor CEO to run your business. You can raise money from suppliers. You can raise money from doing a real estate and a leaseback option thing. You can get equity for value or consulting or whatever you want to do. There's a lot of different structures that don't even require for you to put the dollar in the first place. But it's, again, all about how you position yourself and understanding what's the psychology of the seller and what's possible in terms of closing a deal. And when you see the full picture, when you're looking at a deal, then a lot of the time you won't need money. You'll just need to be resourceful and committed, and to make sure that you have confidence with the deal. The biggest challenge I see, guys, that a lot of people, if they never did a deal before, they just don't have the confidence to do a deal. That's one of the biggest, I think, value of working with us, because you get a second set of eyes, you get in confidence to know if a deal is good or not, and to know if your actions are good or not. Because many times the only thing that's holding us back is just confidence to do the next action. If we're not certain about that, if we're not clear about what's next, then we hold ourselves back, we limit ourselves, we stay in our comfort zone. And it requires, a lot of courage to step outside our comfort zone, but sometimes it just requires a second set of eyes from someone who's been there, done that. And that could give you a huge, like a quick jump to where you want to be. Thinking of a platform company as one whose management team will run the firm. Oh, it's RB2. And in addition to what you said on why a company won't sell to the management team, well, guess what? First of all, not most people don't want to own their own business. That's first. Second, most people don't even know it's possible to buy a business. So you're asking why most management teams are just not buying their businesses from the sellers. Those are the main two ones. Most people don't even know it's possible. And second of all, most people just don't want to do that. Most people don't want the responsibility of owning a business. You think owning a business is easy? It's not a walk in the park. You're going to have ups and downs as well, man. Nothing is walk in the park. At the same time, I don't think that working 9 to 5 is walk in the park either. I don't think that growing your business organically is a walk in the park either, right? At some point, you'll hit a plateau, and then you just need to make your decision you'll need to make a decision of what's next. How do you want to break out of that plateau? How do you want to skip those breakpoints that you'll have as an entrepreneur, as a business owner? And you will have them if you want it or not. All of us will experience those, but you just need to learn to anticipate and learn what are those breakpoints you're going to experience, and just prepare to them in advance as much as possible. And I think that acquisitions are probably the fastest route to skip a lot of those breakpoints as an entrepreneur. Right? Show me another way of growing your business. Like you only need acquisition is the only way that I know that you can grow your business 100% year over year in an afternoon. Right? As soon as you close a deal, you can basically double your business if you buy a similar business to yours. I'm not even talking about if you don't have an existing business and you're buying a business doing 7 figures, you can pretty much create a generational wealth with one deal. So that's why I'm biased about around that space. What about seller financing? Yeah, definitely one of the ways I didn't talk about seller financing much, because I don't know. At this point, I talk so much about acquisitions, so I feel like everyone knows about seller financing. So I'm kind of trying to talk about other stuff. But yeah, 100% seller financing is definitely one of the structure you want to utilize in deals as much as you can. All right, guys, let's see if you have more questions. Otherwise, we'll just finish the call. Okay, see. Abby's asking, so you can bolt on and have that management team integrate and run them, but not necessarily 100 million revenue size. I'm not sure if there's a question here. How often are we paid from the business once we buy it, monthly or yearly? Yeah, I mean, good question. So when you're the business owner, guess what? When you're 100% owning the business, you can do whatever you want, right? It's your business, it's your money. As far as I'm concerned, close the deal and bankrupt the business. Obviously, I'm joking. You don't want to do that, but you can do that if you want. Like, it's your business, it's your money, it's your account, unless you have a specific rule with the banks that want to allow you to do X and Y, then you do whatever you want. You can pay yourself monthly, yearly, weekly. You can pay yourself an income, dividends, obviously. So consult your tax advisor to see what makes sense the most for you. But it's your business, my friend. When it's your business, you do whatever you want. Just make sure, guys, just make sure you keep some money in the business to run it, right? Another mistake that I see a lot of people doing for the first time when they own a business or buy a business or run a business is they make some money, and then immediately the first thing they're doing is they're taking money out of the business to buy themselves a nice car or a nice watch. And it's probably the most stupid thing you can do. Right? Like, reinvest the money, guys. Reinvest the money, grow the business. Place to begin with. Like, don't take money out of the business until you have some kind of stability in the business. And enough capital that allows you to hopefully grow the business and then maybe take some more money out. But yeah, like, first of all, of course, you want to have enough money to operate the business. But then if you want to grow your business, then guess what? To grow a business, you need to reinvest back. It's like I had a conversation in the past with someone who told me, hey, man, I want to have a 50 million, or no, he told me I want to have a 25 million a year business. I told him, cool. Like, you understand that to get a 25 million a year business, assuming you have an average margin, you probably need to spend about 20 million a year. Do you understand that? Because most people don't. Right? When you have a business, you're making revenues. That's not the money that's left with you. So let's say if you hear that a business is doing 25 million in revenues, guess what? Not 25 million is going to go into your pocket. There's a lot of expenses to a business, right? You have cost of goods, you have marketing expense, you have employees, payroll, and tons of other expenses for a business, right? So by definition, to be a 25 million a year business, you need to spend about 20 million a year. So you need to ask yourself right now, are you willing to spend right now enough so you'll get to that point? If you won't be willing to spend that kind of money, and a lot of business owners are just afraid of spending because they're saying, I'll just take money out, every dollar that's coming out, I'll just take it out and I'll buy a car or a watch. You'll never grow that way. To be a bigger business, you need to spend more, period, right? The biggest businesses in the world, they're spending the most amount of money. Yes, they're making the most amount of revenues, but they're also spending the most amount, right? They bring it in, they hire more people, they buy more companies, they reinvest back into different expenses for the business. But a lot of people, especially if they're first-time entrepreneurs, they're afraid. They're just afraid to invest. They're afraid to spend on their business, and they just prefer to go out there and buy a nice watch. For who? For what? What are you going to do with the watch? Right? Think about it. But as a business scout, does everything you say now apply? Oh, so as a business scout, no, if you are a scout, you're getting paid 10% of EBITDA. So if you're bringing $1 million EBITDA, you're getting paid $100,000 at closing as a scout. Now I'm talking about you out there doing deals on your own. That's when you can pay yourself whenever you want. Should be monthly when you think. Yeah, guys, there's a lot of ways to pay yourself when you're the owner. David, you mentioned monthly one, I assume, because you're thinking about an income. But when you're the owner, paying yourself an income is not necessarily the best way to pay yourself, right? And I don't want to make this conversation about taxes, but yeah, it really depends. Any thoughts you can share about what you look for in hiring a CEO to run your new acquisition and where to find them? Yeah, great question. So when we work with our clients, we show them how to either promote from within, hire them from the outside, promote from within, hire from the outside, keep the seller for a transition period. Yeah, get a one from a competitor. Those are kind of the main ones. If we do deals as a group, how much are we paid individually as opposed to doing deals on our own? Depends who's on your group. I mean, I don't know who's on your group. I don't know what they're asking for. Right? So I can tell you if you're going to work with us, if you're going to send us deals, you get 10% of EBITDA that you bring in. With others, I don't know. Ask them. See what they'll be open to do. All right, guys. I thought you said something earlier about a group. Sorry. So the group you're probably referring to the scouts. So that's you bringing deals to us. That's you getting 10% of EBITDA that you're bringing us. So for example, if you bring a company doing 1 million in EBITDA, you'll get paid $100,000 for just referring the deal at closing of the deal, and you could get paid with cash or equity in the business. Great insight. Thanks, Mark. Yeah, no worries. Cool, guys. So we'll end on this. I think this was a good, productive session. Hopefully you enjoyed the short presentation I had. Hopefully you enjoyed some of the Q&A. Again, quick reminder, guys, if you want to chat with me or my team, go to acquisitions.com/apply. I'll put the link again. Let me just make sure you guys have the links. Sweet. So I just posted it again. Can we get a copy of this presentation? So if you're part of our group, so go to business. Oh, I'll tell you what, the best way for you, I'm going to send it to my video editor. As soon as he finish editing this video, just removing, I don't know, blind spots, like dead points and whatnot, we're going to upload it to my YouTube channel. So if you're not following me, just look for me on YouTube. I have tons of videos in there. So if you want to continue to listen to my voice with my weird accents and you want to see hundreds of those videos, feel free to search me on YouTube. All right, guys, cool. I appreciate you all. Thank you for spending your Tuesday with me. I wish you all a great rest of your day, week, and I'll see you soon. Take care, guys. Bye-bye. Cody, good to see you, man. Take care, guys.